Handout page 20. That's what we had left on incorporating financial distress cost. So, and what do we mean by financial distress cost? Now, this refers to an event that occurs when the company is facing financial problems. And they include, we have bankruptcy, where the company is unable to meet its financial obligation. And if I'm going through financial distress, may not necessarily fail, but may survive or may be in a position to identify the surviving strategies. And we have various forms of financial distress. Number one, we have the technical insolvency. We also have legal bankruptcy. We have economic failure. Yeah, that means this is where the company is facing financial problems due to the economic situation of the country. Also, you have the business failure. Yeah, mostly when the company is making a lot of losses. That's what we call the business failure. Also, you have the fraud-based insolvency. This is where the company, the outflows are more than the inflows. Yeah, that means to make the company to struggle financially because the outflows are more than the inflows. Good. Now, then we have various types of financial distress. And they are classified into three. Number one, we have the direct financial distress. Then number two, we have the indirect financial distress. And then also we have the agency cost. Now let's start with the first one. That's the direct. Yeah, under direct distress costs, number one, these costs include sale of company assets so as to improve the financial position of the company. Yeah. If you see your company, they are selling their non-current assets so that they can afford to pay you a salary. That's one form of direct financial distress cost. Also, number two, changing the dividend policy of the company so as to meet the financial difficulties of the company. Maybe the company dividend payout ratio was 40%, but now they change it to 20%. Yeah, that means the company is facing direct financial distress cost. And then number three, also avoiding investing in profitable projects which are considered to be risky, as well as if the company is put at a receivership, now that means that they have tried all their best, and now the company to be liquidated. Now, if you appoint a liquidator, it's upon the company to pay the liquidator all the costs, all the expenses incurred, bared by the liquidator. So that's another type of direct distress cost. Yeah, if the company is put under receivership, the bankruptcy cost will include the legal fees and the management expenses. Then we have indirect distress cost, where the company can suffer indirect. Now, for example, assuming that your company has not paid you a salary for 3 months. So what will you do? You sue them. No, you cannot sue them. Even if you sue them, you'll cast. Can you imagine now you are claiming your salary of maybe 40, 50,000. Then you need to go and hire a lawyer. And then number one, you have not received your salary. So that means you're extra broke. Yeah, so you start looking for green pastures, right? Yeah, so that means there is loss of employee. Also for the from the customer. When there is that kafununu that this company might fall. So you as a supplier, number one, you cut off your supplies. Then the customer from the other side. Now, for example, if you are SACCO or your bank, they are facing financial distress. What will you do? The first thing you go and withdraw your money, right? Yeah, that means you lose the customer. Good. Now, one of the indirect distress costs that high cost of borrowing. Number two, high labor turnover, which will affect the company's profitability. Yeah, when most of the employees are just leaving the company, because the company is struggling financially, they cannot be able even to pay their salary. Yeah, that one will affect the company's productivity. Also, lost sales due to the fear or lack of trust from the customers, as well as managers may take some action to save the company, which may affect the company in long run. Then another type of distress cost is agency cost. Now, agency cost, if the company has debt holders, they need to protect their claim. And how do they protect their claim? For example, the debenture holder, whenever the company is having a board meeting, there must be one of the representatives representing the debt holders. And all the costs incurred, the sitting allowance, all the traveling expenses will be beared by the company, not the other debenture holder. So that cost is being incurred by the company. Yeah, so that means under agency cost, these are the costs incurred due to conditions set by the debt holders. So now these are costs incurred by the company as a result of conditions set by the debt holders in order to protect their interest in the company. They include conditions like number one, no payment of dividends unless earnings of the company exceed a particular limit. Yeah, from the company's earning, always the debt holder would be number one to be paid. And that's why they are paid their interest even before you pay the tax. What about for shareholders and the preference shareholders? We pay the tax, what remains is what we will pay. And it's not a matter that you have to pay the shareholder the dividend. Even the company can make a profit and decide not to pay what? The dividend. What about the debt holders? Even if you make a loss, go and borrow somewhere else, you pay them their interest. Yeah, that's a legal requirement. Then number two, no additional own capital that should be raised by the company unless the current borrowed amount has reduced to a particular amount. Also, the cost of capital and other costs paid by the to the agent who are appointed to the company's BOD in order to protect the interests of the debt holders. As well as another agency cost is no investment in particular project is considered to be risky by the debt holders. Now, what are some of the indicators of financial distress company? How can you know that this company is struggling financially? For example, you see some companies closing down some of their branches. Also, effecting a retrenchment. A company is doing great, you don't expect them to retrench people, right? If the company is doing great, do you expect them to close the branches? You expect them to expand, Yeah, so now let's look at that. Indicators of financial distress company. Number one is the reduction in dividend per share. Also closing down the branches of the company, retrenchment of staff. Also when they have accumulated losses, top managers resigning from the company. Also operational inefficiencies. Slow-moving items leading to obsolescence, frequent losses. Yeah, loss of key customer, or staff, or supplier. And then inability to meet the client's demand. What are some of the options at the type of financial distress company? Now, assuming you have a shop or you have a business, and this business is struggling financially, how can you try to save your company? Let's discuss them. Don't read what is there. How can you save a financial distress company? Hey, I'm expecting point after point after point. You can effect a merger, right? Yeah, merge with another company so that you can enjoy the economies of scale. You can issue shares. It's a limited company. Issue more shares so that the shareholders can inject more capital. Let's read them. Number one is disposing of some unnecessary assets. Also, you can effect mergers. Also, making special arrangement with the creditors. Maybe if the creditor have given you 2 weeks, try to negotiate with them to give you at least 3 weeks or even 1 month. But for you, be hard on the debtors, on your debtors. If you have been selling on credit, now be strict. You only be selling on cash. You insist on cash sales. Yeah, because that's one of the another challenge of financial distress company where most of your sales are on credit. More credit sales, more provision for bad debt. Cash sales, less bad debt provision. Yeah, also issuing of more shares, liquidation, but that one should be the last resort. That means you have tried all the other means. The last resort, that's when you liquidate the company. Also, you can effect retrenchment. It's another strategy. Yeah, doing company reconstruction, try to entrench. Yeah, also merge some departments. For example, you can merge which department? Accounts and HR. or admin and accounts, you merge them. You don't have to maintain the two departments. It's another strategy. Also, delay payment as much as possible. We have said that for you, insist on cash sales. But when it comes for you to pay, delay as much as possible. Yeah, that one actually is one of the good financial management skill. When paying, delay as much as possible. When going for your money, insist on cash. Yeah. Then number 8 is merging of departments. Now, what are some of the causes of financial distress or corporate failure? What can make a company to face financial problem or can make a company to fail? Number 1 is mismanagement. Also stiff competition. Also hard economic condition. It's another factor. Political interferences or political instability. All that. So now let's go through that. Number 1 is mismanagement. I have competition, technological innovation, also political instability, government policies, such as changing tax structure. Yeah, when the tax rates are too high. Also operational inefficiencies, and then resignation of the top management personnel. And then how do you predict the corporate failure? How can you predict that this company might fail in the near future? Number 1 is continuous decline in the share price of the company's stock. Also delay or default in the repayment of the bank loan. Yeah, also delay or default in the payment of creditors. Legal cases pending in the court. Yeah, that's another indicator that you have like 3 cases in court. One, you have been sued by KRA due to the civil debt. The other one by customer for the breach, either customer or supplier due to breach of contract. Another one is by your competitor due to infringement of some patent rights. Yeah, you know that this company might fail in the near future, as well as poor maintenance of the company assets or facility. Good, that's right. Right. I hope you indicated this. Where you have incorporating financial distress, can you indicate handout page 20? First of all, indicate handout page 20, because you might ignore the theories and are highly examinable. Let me say that. When incorporated financial distress cost, when incorporated financial distress cost, comma, the value of the company of the delivered firm, the value of the company of the delivered firm reduces beyond the optimal structure, reduces beyond optimal capital structure, beyond the optimal capital structure. Yeah. And how do we get the value of the delivered firm? According to the value of the delivered firm is the value of ungeared plus present value interest tax shield benefit. But in this case, we're incorporating the financial distress cost. So you deduct the present value of financial distress cost and the present value of financial distress cost. You can show that. December 2007, question 1. So part A of the question, you are told that with reference to capital structure decision, briefly explain the following costs. Number one is financial distress cost. You get your 3 marks. Number two is the agency cost. You get your 3 marks. Those are 6 marks. Part B of the question. Dowanox Limited, an unlevered firm. Can you understand that? An unlevered. So that means the company is all equity financed. There is no debt in the capital structure. Dowanox Limited, an unlevered firm, generates average earning before interest and tax of 20 million per annum. That's the EBIT. The market value of the company as at that 1st October 2007, the company financial year end was 120 million. Yeah, that 120 million was the value of the company. And you're told that the company is all equity finance. That's the value of ungeared firm. The management of the company are considering the use of the debt to finance, debt finance, and have provided the following additional information. Now, the company is considering to use a debt. So that means it will change the status from being unlevered to levered. Number one, the estimated present value of any future financial distress cost is 80 million. Number two, the probability of financial distress would increase with leverage according to the following schedule. So given the value of the debt, and then the probability of financial distress. Number three, the corporate rate of tax is 30% required. The company's cost of equity and WACC as at that 1st October 2007. The company cost of equity at WACC. The company is ungeared, and we say that the cost of ungeared firm is the same as WACC. So how do we get cost of equity? The value of the levered firm, sorry, of unlevered firm. How do we get the value of ungeared firm? It's EBIT 1 minus T over cost of equity of ungeared firm. Now what we need is the cost of equity of ungeared firm. So you make it the subject. To get the cost of equity of ungeared firm, you take EBIT 1 minus T over the value of ungeared firm. How much is the EBIT? 20. 1 minus you get 0.7. How much is the value of ungeared firm? 120. Good. So give me that in percentage. 14 over 120. In percentage? 11.67. Yeah, that's the cost of equity of ungeared firm. And the cost of equity of ungeared firm is the same as WACC. Number two, the company's optimal level of debt finance using Modigliani and Miller with tax model, excluding financial distress costs. The company optimal level of the debt. So that the optimal capital structure of the company is where the value of the company is maximum and WACC is minimum. Now, in this case, we want to get the optimal value of the debt. So how do we get the value? See, in this case, we are planning to use the debt. So that means the status of the company will change from being ungeared to geared. And according to MM, how do we get the value of the levered firm? Is the value of ungeared plus present value interest tax benefits. So you're given the debt level, we can use 25, 50, 75, 100, 125, 150, 200. So to get the value of the levered, you take the value of ungeared. How much is the value of ungeared firm? Then to get the present value interest tax shield, we see that you take the tax rate times the value of the debt. So you take the tax rate then you multiply by the value of the debt. Here the debt is 25. Here we have it's 50, 75, 100, 125, 150, 200. This one is 127.5. This is 140. Mm-hmm. 12.5 times 3, 25. 97.5. So you get 157.5. So now we say that the optimal capital structure of the company is where the value of the company is maximum. Where do we have the maximum value? So the optimal debt level, they should use 200 million. Good. Number 3, the company optimal level of debt finance using with tax model incorporating financial distress cost. Now incorporate financial distress cost. Incorporating financial distress costs. The value of the delivered firm is equal to value of ungeared plus present value interest tax shield. Then you minus the present value of financial distress cost. So you have the debt level, use 25 million, 50 million, 75, 100, 125, 150, and 200. Now we already have this, the value of ungeared plus the present value interest tax shield. That's what we are computing here. So if you use a debt of 25, this one will be 127.5, 135, 142.5, 150, 157.5, 165, and 180. So now we have that. Then we deduct the present value of financial distress company. Note number 1. The estimated present value of any future financial distress cost is 8 million. So you minus 80. Then you multiply by. Now, what's the probability that you use a debt of 25, you'll face financial distress? 0. If you use a debt of 50, 0.0125, 0.025, 0.0625, 0.125, 0.3125, 0.75. That's 60, that one you get 120. This is 127.5, 134. $140.5. Sorry? 140. Which one? This one. This one can't be 100. This is one. This one. 147.5. This one is 145. Good. So the optimal capital structure is where the value of the company is maximum. Where do we have the maximum value? 147.5. So incorporating financial distress cost, they should only use a debt of 125. So the optimal debt level is 125 million. Good. You get your 20 marks. So now you can copy. So open May 2021, question 3. Part B of the question, I told that Bamboo Limited is currently an unlevered farm. The farm is expected to generate a constant operating profit of 20 million per annum in perpetuity. The farm current market value is 80 million. The management is considering undertaking an expansion activity by the use of debt financing. The farm financial analysts have estimated that the present value of any future financial distress cost is 8 million. However, the probability of distress would increase with leverage according to the following schedule. So you are given the value of the debt and then the probability of distress, financial distress. And then we have the pre-tax cost of the debt. Corporate tax rate applicable is 30%. Required. The current cost of equity and the WACC of the firm. Number 2, using pure Modiglian mirror with tax model, determine the optimal level of the debt. That's what we did here. Number 2, evaluate the firm optimal capital structure when financial distress costs are included. And if you look at the value of the debt, can you go how you have the value of the debt? The first one is 2.5. Actually, they are this figure. They only divided it by 10. Eh? And then probability. Are the probability the same? They are the same. You see, in that case, we're given a percentage. Eh? Yeah, for example, the last one is 75%. That's 0.75. The last is that 1.25%. So it's equivalent to 0.3125. You get your 14 marks. So can I go and try that question? Now let's look at something else, subtopic, a subtopic. Predicting corporate failure. Predicting, sorry? Sorry? No, you don't have to apply, but you can apply it. Eh? You see, we see that the optimal capital structure of the company is where the value of the company is maximum and WACC is what? Minimum. So you can decide to determine the optimal capital structure by determining the value of the company the way we did. Eh? Or you can determine using the WACC. How do you get the WACC? Weight of equity, cost of equity, weight of the debt, cost of the debt. Yeah, so you can use any of the two. Eh? Yeah, so you determine either get WACC. Yeah? WACC, weight of equity, cost of equity, weight of the debt, cost of the debt, 1 minus T. Do you have the weight of the equity? Haiko hapo, iko hapa, angalia ni hapa. You see that, how do you get the value of the firm? Is the value of the equity plus the value of the debt. Now, for example, in this case, the value of the company was how much? 180. That was the value of the firm, was 180. I'm just using this one. Eh? How much was the value of the debt? 200. What about the value of the equity? It will be how much? It will be how much? It should be negative what? Yes, that's why I aggregate to use this one instead of using the WACC. But actually, that's how you get that. Eh? So you get the weight of equity, weight of the debt. Do you have the cost of equity? No. Using the cost of equity of levered farm is the cost of equity of ungeared plus the cost of equity of ungeared minus the cost of the debt over equity, 1 minus P. And that's where now you're given the cost of the debt. Good. So predicting corporate failure. Predicting corporate failure. Then we look at models of predicting corporate failure. Now, corporate failure is associated with financial distress of a company. So how do we predict that? We go back to a handout page 22. Handout page 22. Yeah, hoping we are there. Now, predicting of corporate failure. Now let's look at models of predicting corporate failure, which are various methods used to determine the corporate failure. Number one, we have what you call the Altman Z-score model. Yeah, that model was developed by Professor Edward. Number one, it's Z-score model. Now, this model uses various financial ratios to determine whether the company is a going concern. And according to Z-score, the Altman Z, or Professor Edward, came up with this model of predicting the corporate failure. 1.4, sorry. 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus 1 x5, where what is x1, what is x2, what is x3, what is x4, what is x5. X1 is the net working capital divided by the total assets. X2 is the retained earnings divided by the total assets. X3 is the operating profit, that's EBIT, over the total assets. X5 is the sales over the total assets. X4 is the market value of equity. Market value of equity. You divide by total liabilities, including preferential capital. Total liabilities. And what are the decision criteria? If Z-score is less than 1.8, this indicates failure. If Z-score is greater than 2.7, this indicates success. If Z-score is between 1.8 to 2.7, this indicates equal chances of success or failure. Equal chances. That one of the model. Now, another common model is the Springate. Yeah, Springate model. And a Springate model of predicting the corporate failure also borrowed some concept from the Professor Edward, that to get the Springate, 1.03A plus 3.07B plus 0.66C plus 0.4D, where what's A, what's B, what's C, what's D. So A is our X1, which is net working capital divided by the total asset. Our B is our X3 here. We take the operating profit divided by the total asset. C is the earning before tax. You divide by the current liabilities. And then D is our X5, sales over total assets. What's the decision criteria? If the Springate model is greater than 0.862, this indicates success. If Springate is less than 0.862, this one indicates failure. Good. So now let's go back to our notes. Now let's start with the first one, Altman Z-score model. Now this model combines various ratios in order to determine whether the company is a going concern. It's evaluated using the following formula. I think I've explained everything. Then the decision criteria. Now, a company with a Z-score of less than 1.8, it indicates failure. A company with Z-score of greater than 2.7 indicates success or non-failure. And then between 1.8 to 2.7 indicate equal chances of success or failure. Now, what are some of the applications of Z-score model? Where do you apply this model? Number one is to evaluate the performance of the company's manager, also to predict the corporate failure in local companies, also to determine whether the company is a going concern, as well as to determine whether the company can enter into strategic alliance, such as mergers and acquisition. So what are some of the weaknesses of Z-score or limitation? If you want to understand Z-score well, you see a thing that Z-score uses some financial ratios. So what are some of the disadvantages or limitation of ratio analysis? What are some of the disadvantages of ratio? Number one is that ratio uses historical information. Number two, ratios uses financial information which can be manipulated by the company to suit the objective of the company. Also, ratio does not capture the qualitative elements, does not also take into consideration the inflation. Also, for Z-score, it only considers some ratio. That means it ignores other ratios. We have several ratios. Which categories of ratios do you know? We have profitability ratio, we have valuation ratio, we have gearing ratio, we have efficiency or turnover ratio. What else? All that. So now let's look at the weaknesses of Z-score or the limitation. Number one, it does not take into account all ratios that measure the company's performance. That is the profitability, the gearing, and the liquidity ratio. Number two, it uses historical data, which may not be accurate in predicting the current and the future performance. Number three, it uses financial data, which are likely to be manipulated by the management in order to reflect the favorable picture of the company. And then number four, the sample of the variable may not be random. Then it is not, we know that. Let's go to number six. Does not consider the tax effect in evaluating the performance. See these ratios, there is nowhere we are factoring the tax, so it ignores this tax element, because even when dealing with the operating profit does not take into account the tax element. Now, that's one of the methods of predicting corporate failure, which is the major common method. Yeah, Altman Z-score. Then number 2, we have Beaver's model. Number 3, we have Argentis model. Number 4, we have Tafra's model. Number 5, we have Farmer's model. Number 6, we have Zeta model. Number 7, we have the Springate. Yeah, this is another common method. Now let's go through the Springate. Now this model was developed in 1973, and the developer came up with the following ratios. Yeah, 1.03A, 3.07B, 0.66C, 0.4D. I think I explained everything. Yeah, even the decision criteria. Number 8, another model is conditional probability model. Also the use of capital market data. Also inflation accounting and failure prediction. Also the use of non-financial indicators. Yeah. So I want you to do this. Number 1, right? Altman Z-score model. I go back to our notes and we write Altman Z-score model. Altman Z-score model. So I want you to copy everything there. For Altman, you copy even the formula, decision criteria, and the limitation. Now, once you are done, number 2, you copy Springate. You go where you have the Springate, you copy even the formula and decision criteria. Then number 3, you just state the other method. You don't have to explain, just state them. Just state them. You do it now. I'm giving you a hint on how to understand this formula because there are too many. Now, the remaining topic is all about formulas. And if you cram them, you might interchange them. So you just prepare kama Kenya, then you take a screenshot. Ikue kwa simu. Then per day, make sure you go through them. No, it might be difficult for you to carry a book. Yes, but if you take a screenshot of mergers and acquisition, lunchtime unaangalia mara moja. For just 2 days, that thing will stick. Yeah. Morgan and Mira, you do the same. Take a screenshot because you use your phone frequently. Lunchtime, asubuhi when you're going to work, if you're not driving, we're just kaa tu kiangalia, bora tu uchunge simu Nairobi. Yes, going the same. I'm trying to give you this trick. Ngojeni mtakibia the last minute. Mtaona venye mtaona. So, and there are many, this formula are many. Now we can do some illustrations. Yeah. Now let's do the question. Leave a space. November 2020. So 1B. Professor Edward Altman model for prediction of bankruptcy is given as follows. So they have given you the formula. X1, X2, X3, X4, and X5 are the financial ratios, which according to Professor Altman have the discriminating power, where X1 is the net working capital over the total assets, X2 is the retained earnings over the total assets, X3 is the operating profit over total assets, X4 is the market value of equity shares divided by the book value of the debt, including the preference share capital. X5 is the sales over total assets. Given below are summarized financial statement of Alpha Limited for the year ended 1st of December 2019. So given all that. In this model, a Z-score of 2.7 or more indicates no sign of failure. That means it's success. And Z-score of 1.8 or less indicates there is sign of failure. The firm ordinary share are currently trading at 15. Now that's the current market price per share. Required. The Z-score for Alpha Limited. Z-score. So that is 1.2 x1, 1.4 x2, 3.3 x3, 0.6 x4, 1 x5. X1, X2, X3, X4, X5. Now, X1, you're given the formula is working capital. You divide by the total asset. How do you get the working capital? Is the current asset minus current liability. How much is the current asset? How much the current liabilities? How much the total assets? 80 over 400. Zero point 0.5. Yeah, you know, you can't lie to me for numbers. I'm very good when it comes to numbers. For you to get 0.5, it must be 200 over 400. Now, X2, how do you get X2? Is the retained earnings over? Yeah, retained earnings. How much is the total retained earnings? Retained earnings is an amount of 1 over total asset, which is, and you get 0.3. Then we have X3. X3 is the operating profit or EBIT over total assets. How much is the operating profit or EBIT? Haijaandikwa EBIT, imeandikwa operating profit. Na iko kwa income statement, sio kwa balance sheet. Is it 40? Good. Over total asset. How much is total asset? 400. That's 10%, right? X5. Sales over total asset. How much is your sales? 400. How much is your total asset? You get? How do we get X4? Is the market value of the equity you divide by the total liability, including preference share. How do you get the market value of the equity? Let's go to the ordinary share capital. How much is the ordinary share capital? It's 100,000. You divide by the par value. How much is the par value? 10, so that you get the number of shares. Once you get the number of shares, you multiply by the current market price per share. How much was it? 15 shillings. Then you divide by the total liability, including preference share. Now, to the total liability, we have current liability. How much is the current liability? 20. Preference share capital? 40. 10% debenture capital? 80. That is 140. 150 of 140. You get 1 point. .07. Good. Now let's compute Z. 1.2x1, 1.2x1, x1 is 0.2. 1.4x2, x2 is 0.3. 3.3, x3, our x3 is 0.1. 0.6, x4, 1.07. And then 1x5, x5 is 1. So give me the Z-score. You get? What are you getting? Getting? 2.63. You're getting 2.63. Number 2 of the question. Comment on the result obtained in B1 above. Can you comment here? Let's do another illustration before you copy. Yes. If you compute what? Yeah, you'll get the marks, yes. X1, you get a mark. X2, you get a mark. Actually, each of your X, you get a mark. December 2021. Question 3C. Now, in accounting, we don't, it's except for FR. No FR, we don't mark the balancing, we just mark the entries. Also the same here, we'll not mark these. But to make my work easier, if I see this one is 2.60, that's what I'll start with. I just put a one tick and they give you the full marks. If it's wrong, now that's when I start to look at X1, X2, X3, allocate. Okay? I hope you understand what I mean. If the answer is correct, one tick, 5 marks. If it's wrong, now I take the initiative. I look at X1, X2, X3, X4, but do not give you for formulas. Yes, number does not rise. So we work with this. Because another problem is that we found the student, now they have crammed all the formula. But now, how to apply that formula becomes a problem. Okay. Yeah, umeandika KPEM. How do you get KPEM? Naandika RS is RF plus expected return of the market minus RF. You multiply by the return. You are not given the risk-free rate. Lakini umeambiwa hapo, debt capital is considered to be risk-free rate. Where hujui hiyo hata hukuelewa ni nini. So, will you get a mark? You want to get a mark because you are not able to interpret. You say that we are not given the risk-free rate. Na umeambiwa vizuri. Debt capital is considered to be risk-free. So, it's all about on how to apply this, not how to write the formula. And I hope you checked on the review of the last sitting paper. FR, FM, and AFR. Yeah, you know the review, what happens? Where do you get this review from? Did you go through those reviews? Yes, review. Yeah, those were the questions. You know, after marking, we have to write a report. Yeah, which student question failed? For example, advanced FR. There is something I mentioned about the consolidation. Yeah, go and look at the comments on how it was supposed to be done. The same thing I mentioned here. The same financial reporting. Tax, there was no review. They only reviewed the papers that there were some challenges. That was financial reporting, financial accounting, advanced financial management. Yeah, there was a very easy question on mergers and acquisition, very easy. But most of the students assumed they were correct, but they were very wrong. And the money market. Yeah, so that's where most of the students face challenge. So what happens? The paper which you failed much, the specific question, yes, zitakuwa hapo kwa exam yenyu. So you expect merger again, money market again, financial reporting. Okay, that one you cannot say that because consolidation they must test. Yeah, so that one must be there. So they'll be there again. So, but we shall revise then last sitting. During blocks, we'll revise August, December, and April sitting, all of them. And number C, question 3C. The following data relates to Carbon Limited, a company that operates in the manufacturing sector for the year ended that 1st of December 2020. We have the sales, total assets, total liability, retained earnings, net working capital, earnings before interest and tax, market value of the equity, and we have the book value of the total liabilities. The company is currently paying interest on the long-term debt instrument amounting to 905 per year, and that the company total liability is constituted in the ratio of 2:5 between the current and non-current component. Required. Using the Springate model, assess the financial health of the company, 9 marks, and then they give you the formula. Note, Springate model takes the following form. You are given the formula. Actually, they were supposed to give you only 3 marks. Because you're already given the formula, then you are given the 9 marks. To do what? To just substitute, taking the Let's go to question number 4. 4 part A. Discuss 4 defensive tactics available on target company facing hostile takeover by the predator. Poison pill, correct? Use of parachute. Amesema nini? Golden parachute. Sorry? White knight, square. What else do we have? Sale of crown jewel, correct? All that. Now let's go to part C. Yeah, I like asking random questions so that you can gauge yourself whether you're revising or not, you are not revising. And I always insist on theories. You see, for example, financial distress, we discussed them. But most of you, they never took them seriously. If you ask them tomorrow, you will not remember. For a smart student, kindly be listening to what I'm saying, not what I'm writing. If you want to survive, most of the theories, just be listening to that. But there is no need for you to just talk, and then you revise some few weeks to days to exam. It will be hectic for you. But if you understand financial distress, you don't have to waste time again because you listen to the teacher. Are you getting? Yeah, the pressure is almost to pile up. Just wait, it's next month. That's when you realize that you have a lot to cover. But you have been practicing, you have been listening to what I have been saying. If you understand a topic well in class, you'll spend less time to revise. But come up, you're only here to take the notes. I will be attentive in class. Now let's determine that Springate model. Under Springate, it's 1.03 A plus 3.07 B plus 0.66 C and then 0.4 D. Now let's compute A, we compute B, C, and D. You're already given the formula. A is net working capital over total asset. Do you have the working capital? How much was the working capital? You divide by the total asset, which is? You get negative 0 points. You mean 2, 3, or 4 decimal places? Zero point? Sorry? 3, 6. Now we get B. How do we get B? B is the operating profit over total asset. What is operating profit? EBIT, correct. Yeah, operating profit was an amount of? Yeah, 26,005. Then you divide by the total assets, which is an amount of 49,579. 0.053. C, you take the earnings before tax, you divide by the current liability. Just look at the formula. Net profit before tax. So how much is the earning before interest and tax? 26,000. Then you raise the interest. You have been told that the company is currently paying interest on long-term debt instrument amounting to 905 per annum. Then you divide by current liability. Give me the current total liabilities. Is 50? Yeah, total liability, it's 5044. Now we are told that the company is currently paying interest on long-term debt instrument amounting to 905 per year, and the company's total liabilities is constituted in the ratio of 2:5 between the current and non-current component. 2:5. So it's 2 plus 5, you get 7. So to get the current liability, you'll take 2/7 of 5044. 14? .14. So 1441.14. Give me that. 1.18 Then lastly, D. Now, D, you take the sales, you divide by the total asset. How much was the sales? 678, you divide by the total asset, which is 49,570. You get 0.552. Now let's get our Springate model. It's 1.03A. Our A we have it's negative 0.036. Then 3.07B. Our B we have it's 0.053. 0.66C. Our C is 1.18. Then 0.4D. Our D is 0.52. Now give me that. Zero point 0.45. So you can copy now. Kila mtu andike ili amepata. Now, why are we deducting 905 interest while 2605 is clearly stated as earning before interest? Now look at the formula on how to get C. It's not earning before interest and tax, it's earnings before tax. 14, question 3. Three. Sorry? No, they don't always give formulas. So you agree that you get the formulas, you cram the formulas. Hmm? December 20, question 3. Here is the question. December 2014, question 3. The following are the summarized financial statement of Shinda product, which is facing financial difficulties. So we have the income statement, then we have the statement of financial position. Additional information. Corporate tax rate, 30%. Company share currently trading at 30 per share at the security exchange. The company cost of capital is 12%. Interest rate on the bank loan is 12%. The Altman model of predicting corporate failure is as follows. So you have that. Required. The company's Z-score, comment on the result, 12 marks. Number B, other than Altman model, evaluate 4 other ways of predicting corporate failure. Which other method can you use to predict the corporate failure? Yes? Z-score. Springate. Now let's look at something else. Now you look at the third theory of the capital structure. That's traditional theory. Yeah, we are looking at the capital structure theory. Number 1 was the net operating income theory. Then the one we are doing was MM, or the net income theory, or MM proposition theory. Number 3 was traditional theory. We right? Yes, it's 8 marks. Huh? Right, we see that? According to this theory, the capital structure is relevant. The capital structure is relevant since it affects the value of the company, since it affects the value of the company, and WACC, since it affects the value of the company, and WACC, Full stop. The theory also states that, semicolon number 1. Cost of the debt is always lower than the cost of equity. Cost of the debt is always lower than the cost of equity. Number 2, the increased use of the debt, in the capital structure the increased use of the debt in the capital structure does not affect the cost of the debt. Does not affect the cost of the debt. Does not affect the cost of the debt. Yeah, that's all about the traditional theory. You need to understand those theory of the capital structure. Now, the first one was the net operating income theory. What did it stated? The second one was Morgan and Mina proposition method. What is this stated in relation to capital structure? It said that the capital structure is irrelevant. It does not affect. Those are the points that you should be noting down. Yeah. But now the traditional theory says that the capital structure also is relevant since it affects the value of the company and the WACC. Now let's look at another subtopic, special topics in financing. Special topics in financing. Good. So now that's what we'll be discussing in our next session.